So 2026 is likely to be a down year. Will that happen? I don't know. Most likely. Now, you can either hold on through the down years and keep adding and increasing the value of your portfolio, or you can unload some risk. And we'll talk about some of that. Don't forget, en route, make sure you take some lifestyle chips off as well. This is a really important concept. Lifestyle chips are the ability to take off some profits in things that really matter to you. So if the markets turn around, you don't time the top properly or whatever you're trying to do, you've paid off a mortgage or you bought the car or you bought the holiday. You've done whatever it is that you need for your own life. And you're going to hate selling out when you have to take some lifestyle chips off. But at the end of it, your future self will thank you massively. So make sure you think about that. The time for lifestyle chips are somewhere between December and March. We will obviously get more volatility in the space. Expect 30% pullbacks frequently, maybe 35%. These will happen. Maybe Bitcoin goes to 100,000 and then pulls back to 70,000 and goes up. Don't freak out about it. It's really normal.
February to March could be the best opportunity to lock in crypto gains before volatility triggers another major pullback. That's the latest insight from Raoul Pal, CEO of Real Vision. According to Pal, the crypto market is set for explosive gains in the coming months, followed by potential sharp corrections of up to 35%. These swings are part of the natural market cycle, but investors could be caught off guard without a plan. The key, he explains, is having a clear strategy. You can ride the waves and grow your portfolio, or take some risk off the table, what he calls lifestyle chips. Selling when prices are high may feel counterintuitive, but it's a smart move for long-term financial security. It's not just about chasing gains, it's about locking in your future. Stick around as Raoul Pal breaks down the key signals to watch for before taking profits. Oh, and before we dive in, if you enjoy staying ahead in finance and crypto, consider liking and subscribing. It's free, and you can always change your mind later. Now, let's hear from Raoul Pal with his expert crypto insights.
We all have the inner gambler in us. The emotions run high when crypto's exploding. I get it. It's fun. It's exciting. And before you know it, you're switching out of all of the things you should be holding, your Solana, your ETH, your Bitcoin, your SUI, whatever it may be, and you are holding tons of meme coins, going out the risk curve. These are definitely going to 20x, 50x. And before you know it, they don't. Or you get caught when the tide turns. Don't forget, with memes, you're trading attention. And attention can be persistent, but mostly it's not. It lasts for a period of time and then it dies. And before you know it, you're holding the bag with a bunch of losses and you the cycle again. Please don't do that. I say it all the time. Friends of mine do it. Please, please, please keep your degen bag relatively low. Now, you might want to rebalance it if it does well, if you've chosen well, or you can keep running it. It depends. It's up to you. But again, just remember, don't overstay your welcome in the really risky stuff because you will end up losing money. The other key thing, the actual real hack to all of this is just hold for a long time horizon. Just holding means you don't do anything. It's very difficult to make mistakes. You're self-custodying. You're not trading. You're not trying to scalp anything. You just hold it. And guess what? Over time, Bitcoin's done about 150% a year, including 3 kind of 70, 80% drawdown. By doing nothing, you just compound the returns over time. I like to add to my bags into the big cyclical sell-offs, that once every 4-year down cycle. I like to add, and then your holdings compound and you make more and more money each time. But just have a longer term time horizon. For sure, look at the hourly charts. It's fun. I've got them up all of the time, but I don't trade them. I just hold. I barely do anything. I make a couple of asset allocation switches in the entire cycle, and that's it. And magic happens, and it stops you up. So try your absolute best not to do anything with your main holdings. Also, zoom out. This space is all about noise. It's called FUD, fear, uncertainty, and doubt. You'll find that somebody somewhere is trying to scare you, telling you it's a scam, telling you it's going to collapse, telling you something is going to happen. The Chinese are going to do something. The Russians are going to do something. Something's going to go to war. All of these things are going to come across your screens every day, and they will make you feel insecure. Remember, This is noise. This is an adoption of technology. And if tomorrow is going to be more digital than today, we will use blockchain rails for proof, for social proof, consensus proof of value, of transferring assets, of holding assets. Everything in a digital world is going to require blockchain rails. It'll be equity markets, bond markets, currency markets. It'll be art. It'll be tickets. It'll be anything. Any contract is better on the blockchain because you don't need a trusted third party because the consensus mechanism allows everybody to trust it. So over time, the adoption of Bitcoin is huge. In fact, it's still growing at twice the speed of the internet. Back when the internet was in its early days, something that grows at that speed also goes up in price. So zoom out, remove the noise. If tomorrow is not going to be more digital than today, then start worrying. You can also worry at some point about the big cycles. So 2026 is likely to be a down year. Will that happen? I don't know. Most likely. Now, you can either hold on through the down years and keep adding and increasing the value of your portfolio, or you can unload some risk. And we'll talk about some of that. Don't forget, en route, make sure you take some lifestyle chips off as well.
Bitcoin is often criticized for its volatility, with dramatic price swings such as 40% drops and 30% gains in short periods. However, while the S&P 500 typically sees only modest fluctuations, Bitcoin's returns are much more extreme and have already outperformed traditional assets like Berkshire Hathaway, Apple, and Nvidia regarding overall growth since 2020. Bitcoin's return has been 562% compared to Apple's 192% and Berkshire Hathaway's 107%. Some may see this volatility as a negative, but others argue that it's a driver of high returns. For example, business intelligence company MicroStrategy has shown even more extreme volatility, with massive gains during periods when Bitcoin performed well. That said, embracing volatility is important for investors who want to capture the high returns Bitcoin can offer. But as Raoul Pal said, it's important to approach these swings with a clear strategy, knowing when to hold and when to take some profits off the table. Let's return to Raoul Pal as he goes deeper into this important point.
This is a really important concept. I've got another video on this, but lifestyle chips are the ability to take off some profits in things that really matter to you. So if the markets turn around, you don't time the top properly or whatever you're trying to do, you've paid off a mortgage or you bought the car or you bought the holiday. You've done whatever it is that you need for your own life. And you're going to hate selling out when you have to take some lifestyle chips off. But at the end of it, your future self will thank you massively. So make sure you think about that. The time for lifestyle chips are somewhere between December and March. We will obviously get more volatility in the space. Expect 30% pullbacks frequently, maybe 35%. These will happen. Maybe Bitcoin goes to 100,000 and then pulls back to 70,000 and goes up. Don't freak out about it. It's really normal. But remember to take some lifestyle chips off at some point. Then you're just going to have this sense of security that you can run the trade longer. You can't just leave it all in and hope that you get it right. So again, I'm trying to save you from yourselves here. And the other thing is buy the dip if you can. So if it does sell off 35%, you've got a bit of extra cash, buy it if it's not the end of the cycle. If it is the end of the cycle, then you wait till it goes down 70% or so, and then you pile in as much of your savings as you can on top of your existing holdings and let the magic compound over time. Let me tell you a little bit about that because I've learned that the hard way. So the mistake there was I bought Bitcoin at $200 back in 2013. Amazing. I then rode it all the way down 85% because I knew it was a long-term bet. It then went back up in 2017 and it was trading about $2,000 and there was some FUD, the forking of Bitcoin into two different Bitcoin blockchain. And I was like, I don't really understand what's going on. And so I sold out. So it was the FUDs that got me. And I then had sold out. But I was pleased. I'd made 10 times my money. Great trade. And I thought, I'd done it well. It then went up another 10x in the last 5 months of the year, which was unbelievable. I've never seen anything like it. I missed that, but I was fine because I'd taken money off the table. I'd taken my lifestyle chips out. So I felt pretty comfortable. The market then falls all the way until 2019. So that was the down year of 2018. And 2019, I started looking at it again. And really in 2020, during the pandemic, when it fell 50%, is when I got back in. I think I averaged in about 6,500, and I'm still long to this day. Okay, so that looks pretty good. I bought it cheap. I sold it expensive. I bought it back cheap. But when I looked at it, and I bought a lot more at the end, the second time around in 2020, when I go back and look at, if I just held my original bet, which was much smaller, I'd have made 5 times the money from trading it. You see, that's the issue here. Now, had I listened to myself and bought the big sell-offs and doubled up my position every 4 years when we had the down cycle, I'd have 25x'd my position. And again, you can only do this in the very top tokens, mainly Bitcoin, but maybe Solana, Ethereum. But really in Bitcoin, that's where you can do this very long term, because Bitcoin is much more secure as an asset over time in terms of its adoption and acceptance at large. Then you can diversify out into riskier stuff. But buying the dip would have made me a fortune. The FUD cost me money. Trading cost me money. I didn't do the hold. You see, so there's a number of ways you can lose your tokens. That's when an exchange goes down. Or you start using DeFi and you put your money for a yield into something, which is what people did in Terra Luna. And again, I did not do that. Or BlockFi or Celsius or all of these things. Everybody lost money because they parted with their token. Storing in the wrong exchange. OGs remember Mt. Gox. They still have been paid out. That was, 10 years ago. So that's why I don't like to keep things on exchange. Hold on, let the gains compound. I've also screwed up by having this big diversified bag where I thought, all of my tokens will go up, and I tried to asset allocate. That screwed up, and I've got a wallet of shame like most of you have. And that failed. A lot of people have got wallets of shame from the NFT craze in 2021, and many of you will end up with a wallet of shame from the meme coin craze. So in meme coins, keep it to a small weighting, please. It's great fun, get involved. But if you've got too big a weighting, you risk losing everything. And then with rule number 1, which is don't lose control of your tokens. And leverage is another one. If you remember, I bought call options on ETH. I knew I could lose 5% of my capital. Most of you don't trade options, but you trade perps. And perps give you leverage, and before you know it, the market has that 35% pullback that you expect, and you've lost control of your tokens, and you're out of the game. Staying in the game is how we get from 3 trillion to 100 trillion. I don't want you to. So learn from me. I've many times in the past, and I don't want you to do it. We will all screw up in some way. We'll get something wrong. Nobody can get this all right, but just adhere to the main principles, and you'll have a much better chance of in your future.
And that was Raoul Pal, giving us some solid wisdom on handling the wild crypto market. As he said, the key to long-term success in crypto is to avoid the common mistakes many investors make. Don't get caught up in the hype, stay focused on the top assets like Bitcoin, and resist the temptation to overtrade. The volatility and noise are part of the game, but sticking to a strategy of holding for the long haul, avoiding risky bets, and making smart moves during market pullbacks can set you up for massive returns. By learning from past mistakes and focusing on what matters, you'll avoid the pitfalls and let your investments grow steadily. Stay disciplined, stay in the game, and watch your wealth compound over time. Before we go, if you want to stay most up to date on the crypto and Bitcoin world, subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis. Trusted by over 50,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it gave you some value. I'll see you all in the next one, and as always, all the best.